Stocks finished the day on the downward note. They actually started pretty positively this morning, but tariff news and Nvidia post Nvidia earnings reaction and stocks just didn't have a good day today. The question is whether or not the indications are all there that we have an intermediate decline right now. The question is whether or not the intermediate decline will be done now, or maybe have a little bit more left to it. Or are we likely to turn it into something more? So I'm going to break that down in today's video as to how close are we, like if we're close to being done, how close are we to being done? Could it be today? And then also, like, what are the indicators kind of look at? And then also, what happens when it does turn into something more? Like, again, the last time we actually had a correction was in 2022, late 2021, 2022. And there are some signs now, in particular with small cap stocks, I'll show you that, that indicate that we might be leaning in that direction, more so than just being done with a typical pullback, as we've seen a couple of times even this last calendar year in 2024. We'll break all that down, see what's driving the action, what's moving sectors and the intermarket relationships, the big three-headed monster that ate us up in 2022, reared its ugly head again today. I'll show you what that is. And then we'll take advantage of the Mag 7 names. It's actually a stock that's on the periphery. It'd be argued it's actually part of the Mag 8 names. We'll take a look at a trade on that stock and see how we can take advantage of any weakness it has as it comes into its own earnings announcement here next week. So let's go ahead and get started. Today is Thursday, February the 27th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old trades, see whether I should stay in them or get out of them. From Market Outlook videos, we also put on today's trade already before the market closed, and it's already moved quite a bit since we put it on just in the last half hour, 15 minutes of trading. So there's that. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit this like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicators. You can see the S&P was down today quite a bit, down 1.5%, over 1.5%. We did have a few things that ended up happening. We had already crossed yesterday below the market sentiment line, but today now the intermediate line is actually crossing the chart's midpoint. So now we have dark pink shading instead of light pink shading. We still have the yellow line because it's still rising. We're below a rising moving average. It will turn red if and when it ever falls to the downside. Now we are more than 2.5%. That's the other big change today. We are more than 2.5% below the moving average, which is significant because that usually signals that we are in an intermediate decline, even if we don't have both dark pink shading and a red line yet. Short-term sentiment, you can see obviously is strongly bearish. Momentum line again down to extreme lows. And we're obviously way below the bull tag low point, which, again, bull tags can either bounce and, take off and make new legs higher, or they can start declines if you don't, if you build on those lows. And kind of like what we did over here and kind of like what we did here. And that's what we're doing as of right now. So a high probability now that we are in intermediate decline, especially considering when you look at the zigzag chart, we're 4.6% down from the all-time closing high. So we're almost to a red tag. Now, the thing a red tag is not a bad thing because a green tag 100%. No, almost always. Always there's a green tag after a red tag. Always there's a green tag after a red tag. The question is what the number will be in the first red tag. If it's closer to 5%, then we can expect to have a pretty good green tag number after. If it's closer to 10%, then the green tag afterwards might not get up to new all-time highs, and that's where we get the potential for correction starting. So we'll see how that plays out. Of course, the biggest reason why we fell today was the NASDAQ 100 down 2.75%. It's now down almost 5% below the moving average. Dark pink shading in a red line, so the moving average is moving lower. The intermediate line now is in bearish territory. So the second time here in the past couple of months that we've had a bearish decline here, but we're obviously a lot more below the moving average now than we were then. And we've really, we've gone from extreme highs to, bearish territory in just a matter of a few days. And again, last time that happened, and it actually happened a lot quicker than this time, but the last time that happened when we were above 90 and went down to below 40 was over here in July of 2024, and you can kind of see what ended up happening there. The Dow Jones Industrial Average, remember, is price weighted, so it's not exactly the same, but you can still, and we were down today, but only 0.5%. The intermediate line did cross below the market sentiment line and the 50th percentile. You have bearish short-term sentiment, extreme on the momentum line. And you have bull tags, and you're barely below the lows, so not quite as dramatic on the Dow Jones. And then finally, your Russell 2000, remember, was already in an intermediate decline. The intermediate line is actually in the lower reversal zone. It's the lowest level it's been since getting these clusters over here. In fact, we almost had a cluster today. We were 20.98. That's how close we were to getting a cluster. And market sentiment's actually almost down. It's down to that 30th percentile. We are in the less than the 5th percentile of how far below the moving average we are at over 5%. So it's pretty low on the moving average line. It's clearly the Russell 2000. In fact, as you'll see here a little bit later, and I tweeted this out earlier on Twitter, the Russell 2000 is not only in pullback mode, it's actually in correction mode. And we'll talk about that and the difference that is. The last time the Russell 2000 was in correction mode while the S&P was still forming new highs, as we did a couple of weeks ago, or a little bit more than a week ago. The last time we had that kind of divergence was back at the end of 2021. The Russell 2000, after faking out, was in its correction. And again, I'll show you that here in just a second. Let's get through the rest of these charts. Let's take a look at the weekly chart here. And you'll see, again, red arrow. We got that transition candle last week. That last week's candle was a bearish candle. We talked about that. It led into this week's candle. We have now clearly dropped below a 5% mark. The gap between these two lines, when it drops below 5% after having been above it, we usually make our way down towards it, like, again, kind of correction level style move. So it obviously is a pretty large bearish candle here. Will be that much bigger next week whenever, depending upon how we close the week here this week, has the potential of being a high probability of being larger next week. We have 3 red arrows across the board here. We know we're close to getting the green arrow on the moving average, which is usually your first green arrow. You're way below these. The MACD histograms are falling, except for the Dow. The MACD histograms are falling. Looking at the 2-line versions, well into the gap between the 50 and the 200 day. The MACD is clearly bearish there. This is kind of where, just to kind of give you an idea of how far the MACD can go. Let's see, let's go SPX. Let's try the SPX I was looking at here. I think it was SPY. Yeah, so we kind of looked at, like, okay, when you get like below this like 0.025 mark, minus 0.025, then you're probably going to be an intermediate decline. You can kind of dip a little bit when you dip to the 50-day and not necessarily get the red tag, the bull tags, get 3 red arrows, but not necessarily have a high probability of bouncing. Well, that's not the case right now. We are clearly, the momentum is clearly bearish enough to be moving down. And the histogram actually, the histogram is pretty bearish, but that's not extreme, especially compared to some of these other bull tags that we got where we bounced off of. So with the above average volume and stochastics getting in the reversal zone for the first time since really the August pullback, which was kind of barely in the reversal zone, and then the pullback that we had in April, clearly something's different now than what we had, these last 3 instances since August. If I take a look at the DMI, the negative indicator is well above 30. It's above 35. The positive indicator is well below 20, almost below 15. The ADX is starting to really move higher as a result of that. It was that squeeze. It was that extreme low, so we were set up for a squeeze And it looks like as of right now we're getting that fake out. We talked about this on these days right here. Actually, we were talking about this in our classes at Market Scholars about the possibility of this being a fake out, and then the squeeze, because it wasn't that bullish of a breakout there, and then the breakout actually being to the downside, and that's ended up being what happened here. If I look at the RSI and the CCI, the RSI has now clearly gone to bearish levels below 40, so that's why they've got the red shading. That indicator is telling us we're in intermediate pullback mode. Sorry about that. Let me make sure the camera's okay. The CCI is close to almost being done. Like, again, we're at minus 84. When we get below minus 100 on the CCI, on the weekly CCI, then the green box stops and we are in correction mode at that point. So I don't know why the camera's doing that. Sorry. So yeah, that is set up for bearishness, for probably more bearishness than what we may be comfortable for. The Ichimoku cloud is showing a weak trend now, above 50 and below -1. Not yet to the intermediate strength trend. We are below the cloud, which is, we typically get to the cloud, maybe a little bit below it, when we are in kind of like the pullback mode, but not correction mode. Getting further below the cloud is different, so we'll see if that ends up happening this go around. Usually by the time we get below the cloud, we usually bounce right back up. So if we don't bounce up immediately in the next couple of days, then there's probably something more afoot than just your typical 5% pullback. If you take a look at the Bollinger Bands and the Keltner channels, again, remember we were squeezing. The bandwidth was at extreme lows. And then now it's rising pretty rapidly as we finished below the lower Bollinger Band, and we finished below the lower Keltner channel. So we haven't done that in a long time, been below both those lines. Again, last time we were even below the, last time that happened was December 17th, and that's kind of started this decline. A couple of bounces, but eventually it's had that intermediate decline there. And the weakness that we had. So this is we are clearly in pullback mode. And again, the question is whether or not the number ends up being closer to 5 or closer to 10. Because if it's closer to 5, then we're probably done. We're pretty close, if not there already, to being done with the pullback. We might not even get to 5, and we get a green box with double digits after it. That's great. That's exactly what we want to see. But if it's closer to 10, then the number in the green box might not get to double digits. We might not get to new highs, and we might ultimately fail. And that's kind of where I was telling you about, the Russell 2000. See, a correction always starts with a pullback. A pullback is when you break the 50 and you work your way to 200. Don't get worked up on media definitions. Media definitions, they have to be really easy because the media is kind of speaking to like high school level, right? They have to keep everything very simple. They're taught to do that way because they want as many people as possible to watch and read. So they keep things at a very elementary, very naive level. Like I said, high school level or probably even less. So they'll say like 5% is a pullback, 10% is a correction, 20% is a bear market. That's naive, right? The reality is it's how something trades. So when a pullback is when you break the 50-day and you work your way towards the 200. You might not get all the way to the 200, but you work your way down towards the 200. The S&P, for example, last couple times never did get to the 200, but it broke the 50. That's a pullback. The 8 and 17 break the 30. That's a pullback. So this was a pullback. Every correction starts with a pullback, but then the pullback bounces because remember, a green tag always comes after the red tag, so you get a green tag. Well, that bounce should fail around the 30 or 50-day moving averages. In this case, it was around the 50. We got to the 50. We couldn't get up above it. Did briefly, but got right back below it, and we failed. And then you break back down below the 200. A correction is when you trade below the 200-day moving average and you start trading towards a 200-week moving average. That's a correction. And then you get a bounce off of the 200-week, maybe a little bit below it, or maybe a little bit above it. You get a bounce off of that towards the 30 and 50-week, and then you fail. And when you break back down below the 200-week, that's when bear markets start, right? So that's how this kind of works. So the Russell 2000 is in correction mode now. It had its pullback already at the end of the year, beginning of this year. It had its failed pullback bounce. And then and you can even see here on the zigzag, when I look at the Russell 2000 here, we had this 10% decline. The red tag was a bigger number than just 5, right? 5 is fine, but when you get closer to 10, then the next green tag is probably not going to get you to all-time highs, nor will it be double digits. And that's what happened on the Russell. And then now we're 7% down off of that already, and we're working our way below the 200-day moving average. The Russell, let me repeat that. The Russell 2000 is in correction. And that's significant because it takes months to get back to new highs when the Russell 2000 is correction. And as I mentioned before, the last time the Russell 2000 was in a correction, when the S&P 500 was not, was the end of 2021. The Russell 2000 was in correction here. We had our pullback that actually lasted quite a bit of time here. We bounced back up. We had a very notorious fake out pattern. We talked about that quite a bit in our classes back then in 2021. I remember that, and a lot of our students remember that as well. Big notorious fake out. That's like, man, if this doesn't hold, this breakout, because we were so sideways for so long, if this doesn't hold, then we are in trouble. Well, we were in trouble. We had the break below the 200 day. We were in correction all the way through the end of the year. Well, remember right here, the S&P 500 hit an all-time high right here at the beginning of January. And the Russell 2000 was in correction. The S&P was at an all-time high. Sorry, let me fix the camera there. Was in an all-time high. That's a problem, right? That is a problem. And we're seeing that problem again here, where the Russell 2000 may be a month or two ahead of what we may be seeing eventually on the S&P 500, because it itself is in correction right now. The Russell 2000 is in correction. So sorry again. Let me fix that again. All right, so let's take a look at some of these other oscillators. The DMI. Oh, I told you. Well, we've already looked at these. The DMI. Let's look at the intraday chart here. So there's the new lows. I mean, look, new 4-week lows, well below yesterday's low, already well below last week's low, and the range is starting to break out, right? The range was very, like we were set up for squeeze play, and it looks like the squeeze is happening in the wrong direction, right, to the downside here. Well below the value area, the 4 weeks. We got a break up to 100 again. The green line's below 70. Remember, we don't have a low point formed on the intermediate low until, and just for an example, the last time we had a correction was 2018 or 2022. So here's what happened there. So we had our intermediate decline. We didn't get a new low for a while. The green line hit 0, the red line hit 70, and we were on the cusp of forming a low like this pullback. But remember, that was a pullback that was not, that was 10%. There wasn't, remember this pullback right here in 2018 was 10%. It wasn't a 5% number. It was 10%. We got a bounce of 6%. So that's what we're looking at. Sorry about that. I don't know why my camera keeps messing up. I need to take a look at that when we're done. But if I go back now to the intraday chart here, so it'd be right here, and go back over here. So let's go back to that 2018 time frame to kind of get an idea of what it looks like when we're in correction. So we had that big drop. It was big short, the pullback. We got a few days of new lows. Eventually, we hit 0 on the green line. So we had the pullback low was formed. We dropped below 70. We hit 0 on the green line. The low point was formed for the pullback. We bounced up, but we failed at that 30, 50-day moving average level, and then we got new lows. We never did get the spike up to 100 because we never got new 4-week highs. Well, that's, again, are we going to get that now? Now, we're just in the very beginning stages because we're at 100, but the green line, because we got the new low within 3 or 4 days of the new high, we got a long ways to go before that green line hit 0. So we don't know if that new low point's formed yet. In fact, most likely it's not, which is a concern because we're already to 5% almost, and we still got a long ways to go before we feel good about the pullback low forming by the time the green line hits 0 and the red line drops below 70. And we can feel good about whatever bounce we would be getting most likely by that point. So we're not close to that yet right now. Remember, the Russell 2000 is already it's in correction mode. It's already in intermediate decline mode because it's on the new phase lower here. Sorry, 1-day chart. So it's already there, right? It had its pullback, big deep pullback. It had its bounce that failed, and now we're back to, red lines at 100 and green lines moving down to 0 because we're getting new lows. Maybe we were already getting new lows before the S&P, and in fact, we were in the lower half of the chart while the S&P was forming new highs. The S&P had a new high here. What was the new high on the S&P was back over here on 219 as when we had the new high on IWM on 219. This is where we're at. We were not even close to new highs. New highs had occurred way before that, and within a couple of days, we're in the lower half of the chart. In fact, we are dropping down to bear. We were already down to bearish levels on the Russell 2000. That happened back over here on 212. We dropped in the bearish levels before it failed, bounce up, and then now the SPX is following suit by getting down to extreme lows, which again it doesn't typically do unless you are in the beginning or potentially at the very end of an intermediate decline. Like this could be the end of it. I doubt it, but this, because you can see it's either the beginnings of it, as you saw here, or it's the end of it, right? As you saw here, and for that matter over here, eventually. So I don't think we're at the end. I think we still got some time before we form that low point, because like I said, we are just barely a few days off of the high point. That takes more time for pullbacks to develop than just 6 days. And in fact, if you look at the rate of change, which is also another factor here in terms of how bearish we are, we've been one. I mentioned to you before that the 4-day rate of change is kind of a big deal here because we were down 4 days. I believe I did this back on the last market outlook. But now let's take a look at all 6 of these down days here, because that includes the 2 kind of big down days that we had. And you can see we're down 4.5%, and that's significant, but it's not extreme, right? If I zoom out, especially so I can see that pullback level, and let's move this line here. Sorry, move this line to minus 4.6%, which is where we're at right now. You can see, okay, that's a pretty decent level compared to all these other pullbacks that we had. We never really had a 6-day run. Last time we had a 6-day run, that amount was the last time we had a correction, right, in 2018. You can almost argue that August 6th got down to a 6-day drop of 5%, but that August 6th wasn't obviously a correction. It was kind of a weird day that day. That was the day I got back from Africa, so I remember that very vividly. A lot of weird things going on over the weekend, and all played out to a big significant gap to the downside, and then we just rallied the rest of the week. In fact, we filled in the gap by the end of the week there. So little different scenario than what we saw over here, where we were in correction mode and we continued a little bit lower for a few more days, and then we had our failed bounce. So that's out there, right? That is something that's definitely a possibility right now. If I look at today's volume and trading ranges, obviously they were well above the average, more than 1.5 times on the volume, so 74 million. The trading range at 13 points, so not including a gap either. So if I take a look at those numbers in context, 13 points is well up here, way off the charts when you look at the ATR. And it's now the ATR is rising back above 1% pretty easy, working its way higher there, and the volume is working. Remember, when those lines move up, we're bearish. We're not bullish, we're bearish. So both those lines are moving higher, as well as the VIX. The VIX is back above 20. It's above 21. It's at 100% relative to the VIX 3M, which is intermediate pullback levels. The VVIX is above 110, which again makes us susceptible to a big jump in VIX, right? So we haven't really had necessarily the big jump in VIX, something like this, like we saw in December, or something like what we saw over here. Like, and again, those look, everything else doesn't look so big compared to those, but just for some context, we can have big jumps in a short amount of time. We haven't had that yet, right? Even if I look at the VIX on the rate of change, so like say the last 6 days on the rate of change, let's go over here, let's look at the VIX, and let's go 6 days, so we can kind of see, okay, have we really had a big spike in the VIX over the past week plus? And the answer is no, right? I mean, we're up 38%, But you can see in December, we had a lot bigger move than that. In last July, last August, we had a lot bigger move than that. If I were to zoom out again, so you can see how things look from the corrections and other instances that we've had. You can see in late 2021, and then again during that pullback move of early 2022 that got down to 10%, we were well above 38% on the VIX. So we still really haven't had a big jump in the VIX. Those numbers, as you can see, were like we were way up here in the 30s. On these two, we were well above. I mean, we're just barely at 21. So with the VVIX where it's at, because it's not very high either, as you can see here, when again, when you look at like some of these other instances when we had these big jumps early in 2023, there's July and August. When the VVIX is at these levels, then that means that something's coming. And you can see it's not just a one-day thing either. Like the 200-day average of the VVIX is now almost at 100. It's sitting there right about, what would that be? Can't really see it. Let me zoom out so I can move my cursor right here. So at 98.73. So we're just a few days away potentially from the 200-day average of the VVIX itself crossing above 100, which puts us in precarious territory here for a different regime, a higher regime for volatility there. And we also see that as well with what the VIX is doing, but we also see that with what the skew is doing. The skew has been so extremely high. It is down to 153 today. You can see 149. It's actually down to 149 today from 153. So it's well below the average. Remember, that's bearish. So 143 is down here. 149 is the thing is where it's at now. Yeah, 149. That's finally below 150 for the first time in multiple months that we've finally broke. Remember, 150 is the extremely high level. So getting below 150 is significant. And we're finally at 149. That's the 50-day, that's the 20-day average. If you look at the 200-day average for the skew, we are barely crossing below it. And that's a big deal. And you can also see too, if I were to change this, and then you see how extremely high that is, much higher than where it was in 2021 when things kind of really hit the fan. But then you look at the 50-day average of the skew, and we are breaking below that in a significant way. Again, that generally means that this is more than just a 1 or 2 day little decline, that things are definitely changing. And the other thing too that stands out is that new highs and new lows are breaking out to high levels above the 4% mark, which also tells us either one of two things. Either today is the low point, we've exhausted the selling, today is the low point, or we, as you can see on some of these pullbacks, it kind of marked the low, or as you can see on other pullbacks, it started the weakness as we saw over here in 2022, in early 2022. And for that matter, in 2023, when we kind of had a correction in the fall of 2023, that was about as weak of a correction. I mean, it never really got out of the pullback zone, right? It never broke the 200-week moving average, but it had all the other characteristics of a correction where you had a pullback, a failed bounce, and then you moved lower. This wasn't a 5% pullback nor a 5% bounce, but it looks very similar. A lot of characteristics of a correction, but it was so weak that it actually stayed, the whole thing stayed inside of the pullback territory. The pullback territory was so again, between the 50-day moving average and the 200-day moving average, the bigger the range is, the bigger the pullback can be and still be a pullback, right? Which, again, means that you can have a correction inside of a pullback, so to speak. So that's when things kind of started there, and 2021 has started too, and are we ending now? Is this the washout phase of this particular pullback, and we're only going to drop 4.6%, or are we just kind of getting started, as we saw in some of these others, where the new lows actually got up to a lot higher numbers, even over here, but even over here up to 400 or 300 a few days during that selling. So that's something to keep an eye on tomorrow and into next week. Outside of that, the rest of the breadth indicators actually don't look too badly yet, at least. If you look at the McClellan oscillator, it is not below minus 35 yet on the McClellan oscillator. Give it a second here to load up. There we go. It's still at minus 27, so that's actually not bad. Now, again, it doesn't take much for the summation index to get back below zero, which would be a negative. Again, it's you typically don't get below zero on the pullbacks, and you start to on the corrections. You can see we kind of had a failure over here in late 2021 before we ramped back up, and then we eventually fell down and we were in correction mode. And so, that's something to keep an eye on the breadth. But as of right now, that's not too bad as long as it doesn't get worse. The other thing too is the number of stocks above the 50-day moving average did falter today a little bit and dropped below. It finally fell below 250. Sorry, the internet's a little slow right now. But you can see it's barely below 250 and barely below its average. We're not below 200 yet at bearish levels, which would be 40%. So we're actually not, it's not bad. And as a result, when you look at the number of stocks above the 200-day moving average in combination with that, which is below 300, but again, not below 250 yet, then the ratio, when this thing breaks above the moving average, it tends to be bearish, right? Well, we're not above the average yet. I mean, we're kind of sitting there, but we're not really above the average yet. So, again, we have a chance for this to be right? For this to be all the selling and for us to bounce back off. And in fact, it kind of has to be if we're going to avoid something more significant, right? An intermediate pullback that ultimately would be more significant than just an intermediate pullback. And so there's a chance that it can be, and we kind of really need it to be. And so it goes to show just how important tomorrow is, and really for that matter, the rest of next week is. Because again, my expectation is probably not done today, that we will, but I'll know if that's the right expectation to have or not really quickly, right? As of tomorrow, Monday, Tuesday, depending upon what kind of bounce we get, right? And again, we can kind of get an idea with the market forecast when we see whether or not the near-term line bounces. When it crosses 40, how does it cross 40, right? Does it only cross 40? Does it cross 40 and 50 or 60 in the same day? Where's the momentum line when it crosses 40? Is it higher than the near-term line or lower? Is it above 80 or not? I mean, those are all things. Where's the intermediate line by the time? Is the near-term line crossing the intermediate line as well? Or is the intermediate line now in the reversal zone? I mean, those are all factors to watch to see, because we're going to get a near-term bounce. It might not be a 5% bounce yet, but it's going to be a near-term bounce. Again, go back to that same 2018 time frame of when we were in a correction, right? You can see like we had a drop, we had a bull tag, we bounced, we had a near-term bounce, and then we fell down. And you can see it, we stayed down for a while. So by the time the near-term line bounced above 40, the intermediate line was in the reversal zone. By the time the near-term line crossed 40, in fact, we even got a cluster. By the time the near-term line crossed 40, the intermediate line, it was in the reversal zone. So, we didn't quite get as bullish of a move higher as we wanted. It ultimately ended up being strongly bullish here. But again, it was a failure at the 30-day moving average, a multiple touch failure at the moving average before we ultimately faltered and started the correction there on the S&P. So we're going to get a near-term bounce. The question is when, and where's the intermediate line going to be when that happens? If it's tomorrow or Monday, then it's going to cross the intermediate line. But if it's not, if we go through all next week and the near-term line is still in bearish levels, and the intermediate line has fallen below 20, now we know that they're probably in for a little bit more than what we're bargained for. If we take a look at the asset classes and how they performed here today, as you can see, remember we had a 6-day decline. So let's look at today, then we'll look at that full 6-day decline that we've had. Obviously, the Qs got hit the hardest. Emerging markets also down 2%. The S&P 1.5%. Small cap stocks also around 1.5%. Bonds are actually down today. So bond yields were higher. The dollar was higher and commodities were higher. That's your triple-headed monster. That was the three-headed monster that hurt us in 2022. It's the three-headed monster that hurts us every time we have any kind of weakness. When the dollar is up, when commodities are higher, and when yields are higher, it puts a lot of pressure on equities. And so when you look at yields, you can see they hit the 200-day moving average and so far have bounced. And we'll see how much that holds and whether we move back up towards moving averages there. Because remember, pull back, you break the 50, work your way to 200, and then you bounce and see what happens. If you look at the dollar index, big break move above both the 8 and 17 today, crossing multiple moving averages. 3 green arrows practically, with the stochastics crossing above its average and Stochastic's almost out of the reversal zone there. Are we getting a bullish bounce right now on the dollar? And then finally, commodities is the other aspect of this, sitting at the point of control, sitting at its 50-day average. Is it starting to bounce along with crude oil, right? Crude oil would be the biggest component of that. We're sitting at 52-week lows, the bottom of the value area. We had a big jump today towards the 8-day average. Are we starting to bounce off of this little divergent low point that we're forming? So one day obviously doesn't make a change, but if we get more days like that, then you can see how significant that can be. And if I were to zoom out now to the 6-day decline that we've had in equity, so 1, 2, 3, 4, 5, 6. So starting there on the 20th, the S&P is down 4.5%. The Qs are down 7%. IWM's down 6%. So they have their red tags. The S&P is not quite there yet. Commodities have been weak this whole time. Yields have been down for the majority of this time. And the dollar, you can see, also was down until today. So, we've had weakness without those three things. And now we get those three things. And today is today is probably, I think it was probably the worst day out of all of them. We were a little bit lighter on that day 2 there, but you can see we are definitely having a rough stretch, as you saw with the rate of change over the past 6 weeks. And you can see with volatility rising and historical volatility as low as it's been, and the gap being as low as it is usually leads to when we get such a big gap, usually the blue line eventually comes up and crosses, and that usually sets our low point, as we saw in August over there. But that's all still to come on the S&P. And if I look at the sectors, obviously the biggest decliners today, or the ones that you would expect would be the bigger decliners in a period like this. XLK down 3.6%. This is not something you'd expect to see utilities down, but again, remember, it's interest rate sensitive, so when yields are higher, it puts pressure on utilities. Discretionary is down 1.5%. Communication services down 1%. Everything else down, but outperforming. And then you can see you have financials, energy, real estate, and staples. So not necessarily your mix of safety, but when you have yields rising, it puts a lot of pressure on some of your safety trades, your typical safety trades, like I said, like utilities down there. If I take a look at the last 6 days again, going back to the 20th, you can see 8% down in XLK, XLY 6%, XLC 4%. Right, we're getting hammered. Those areas, and remember, XLK is not an area of the market that we want to see get hammered, because that is the most important area of the market, and now it's at new lows, right? New significant lows, well below. And if you take a look at the weekly version of this, it's even a little bit more significant, because the weekly chart is also well below the average after having already been below the 50-week moving average on the ratio chart. And then now you can see both the momentum and the relative strength chart are both below 100. So here on the daily, XLK has been moving, where's that? Right there, down to the left on the green chart. Well, if you look at the weekly version of this ratio, this relative strength chart, there's XLK. Where's XLK? Right there. Right, it's turned red. Both lines are now below 100. Right, and that's significant, because that usually leads to weakness, as you saw over here when we had our bout of weakness right there when both lines moved below 100. And even though it rallied a little bit last July, it was an underperformer, and it appears to be an underperformer again. And when you look at like XLK relative to SPY here, I told you we're breaking the 50-day moving average. Well, we're already below the 200, so we don't really want to break. And then the other issue is the Qs relative to IWM. They're both down today, right? But remember, it was so bullish. The Qs were outperforming so significantly that now we're below the 17-day average for the first time in multiple weeks. This is a significant change. The MACD is below its moving average. The histogram is starting to fall in the long-term PPO, and we're coming off these strong bullish levels in a manner that I don't think necessarily we want to see, as we saw back over here in late July when XLK started to underperform there. It's too important of a sector. Both really XLK and as well as XLY, which is also below its 17-week moving average, and XLC, which is flirting with its 8-week moving average. But these are all the most important areas of the market, and as you saw back here in 2022, it starts with breaking the 1. XLK back in 2022, you can see when it broke at 17 clearly, it was done. Now we've had a few breaks that immediately bounce back up. So that's why I say by next week, if we don't bounce back up like we did here in September, like we did in August, like we did in April, if we don't bounce, or even for that matter, back over here in October 2023, if we don't bounce back up immediately, like we didn't over here, we bounced back up, but not back above these averages, we failed, then we're in trouble, right? We're in trouble if we continue even for another week lower on this. And the problem is that I expect that that probably would be the case, considering even if we bounce back up, there's going to be other areas of the market that probably outperform as relative strength looks due to decline for a while. All right, that brings us to our trade idea of the day. Let's take a look at Broadcom here. Broadcom. And you can see the intermediate line has moved down. Obviously, as the near-term line tried to break up above it, but has stopped. The intermediate lines continued lower, market sentiment lines down, market momentum lines at extreme lows. We're at the 4th percentile below the moving average, nearly 12%. Big decline here today going into its earnings. Dark pink shading and a red line. You obviously have a bearish candle this week. The red arrow came last week. Pretty significantly bearish candle too. PPO is falling pretty sharply here. Still at relatively high levels, 78th percentile. So still some downside here. Obviously, we have three red arrows. As you can see, we've had some pretty decent volume when it first started, and even right around average volume here today. MACD and stochastics histogram are down there. And if I take a look at the 2-line version of this, we are clearly below the 50-day moving average, working our way down to the 200, where some point of control is. Again, with the with earnings coming up here, filling in the gap on the last earnings result that we had there to the upside. If I take a look at some of these other oscillators, the DMI is bearish, not as strongly bearish, but it's above 30, below 20 on the positive indicator. The ADX is rising. If I look at the RSI and the CCI, they are also showing bearish levels. RSI below 40, CCI well below minus 100, was below minus 200 when we first started this decline. The Ichimoku cloud, if you take a look at that, cloud's still pink, but we are below the cloud. The rate of change is strongly negative. We have an intermediate strength trend developing here to the downside, with the stock trading below its Bollinger Bands, the lower band barely, but below the lower band, and also below the lower Keltner channel, with some negative momentum in the bands themselves still outside of the Keltner channels. So I decided here to do a long put vertical spread. In fact, we already put it on here before the market close, as we always do in the Market Outlook Live. You can see I sold the 180, bought the 184, looking for the low 20s delta, but now it's already, in fact, the stock is, the trade, when I got into it, we're already, I believe, we're up a couple $100 already, just in the last 15 minutes of trading on this. So you can see here, that's where we got into it, and now this is where we're at, and there's where the maximum gain is. So we still got to get below the 180. Remember, the point of control is right around the 175 level. So we'll see if it ends up filling in the rest of the gap and getting down to that support when I can get about a 3-to-1 reward to risk ratio, with, again, selling the 180 and buying the 184 in this case, because it was 2 strikes away. They're $2 wide, but I wanted to go 2 strikes away here instead of just the 1, and give myself a little bit more room to work with, but like I said, at the low 20 deltas, but of course that's already changed, right? Because we've already gone down just a little bit more from when we got into this. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.